let's jump right into this explainer. Imagine you're standing in the middle of a super busy shop. Customers are buzzing in and out, cash is constantly changing hands, bags are being handed over, and delivery trucks are dropping off boxes out back. It's an absolute whirlwind, right? Well, today, we're going to look at exactly how all of that sheer chaos is actually captured, organized, and transformed into this perfect mathematical balance. It's like a giant puzzle, and we're going to piece it together. You see, every single time someone buys an item, or pays a supplier, or even just pays the shop's telephone bill, a vital business activity happens. But here's the kicker. Not all of these activities involve cash changing hands right at that exact second. The ones that are measurable in cash terms, those are what we call business transactions. And our goal here is to figure out exactly how on earth we keep track of that endless flow of transactions without completely losing our minds. To keep things super clear, we're going to build this up block by block. We'll start with the business transaction itself, then look at the proof behind it with source documents. From there, we'll see how that gets translated into accounting vouchers, check out the specific types of cash and transfer vouchers, and finally, wrap it all up with the ultimate golden rule, the accounting equation.
All right, let's kick things off with Section 1, the business transaction.
So, at its core, every single business interaction is basically an exchange of values between two parties, and it always, literally without fail, involves a give and a take aspect. Think about it like this. Say you're buying a brand new computer for your office and you pay in cash. The moment that computer is delivered to your desk, that's the take. You're taking possession of a new asset. And the moment you hand over your hard-earned cash, that of course is the give.
And honestly, this right here is the whole foundation of our accounting system. We just slap some official terminology onto that exact exchange. The take aspect, we call that your debit. The give aspect, that's your credit. So going back to our office computer example, taking the computer is your debit and giving the cash is your credit. Every single business transaction out there can be broken down into these two perfectly balancing halves.
Moving right along to Section 2, proof or source documents.
Now, we obviously can't just rely on our memories for all these exchanges, right? We need solid proof. Every cash memo you get, every credit invoice, or even that little crumpled receipt they hand you with your morning coffee, these are all known as source documents. They are the absolute primary evidence that a business transaction actually went down. So whenever an exchange happens, a source document is the very first thing created. And because businesses have to be insanely organized, all these documents are serially numbered, carefully filed in chronological order, and tucked safely away.
So the really crucial thing to grasp here is the flow of the information. Step 1, a business event actually happens. Step 2, a source document, like a raw everyday receipt, is prepared as our primary evidence. But here's the thing, that raw receipt just isn't structured enough for the official accounting books. It needs to be translated. And that brings us directly to Step 3, the creation of the accounting voucher.
Which brings us to Section 3, translation, specifically looking at accounting vouchers.
Okay, so unlike a simple receipt, an accounting voucher is this highly structured written document that does a deep dive into the transaction. It basically looks at the raw source document and explicitly states, okay, exactly which account is taking the debit here and exactly which account is taking the credit. Because this actually takes some real accounting know-how, it's drawn up by an accountant and then has to be countersigned by an authorized person in the business. It's literally the definitive bridge between the chaotic real-world event and the pristine official books. Let's dive into Section 4, types of cash vouchers. To keep things organized, we neatly divide our cash transactions into two distinct directions, money flowing out and money flowing in. Debit vouchers are strictly used when cash is leaving the business. You'd write one of these up when you're paying for expenses, buying new assets, paying off suppliers, or paying down a loan. On the flip side, we have credit vouchers. These are strictly for cash flowing into the business. So you use these when you make a cash sale, sell off an old asset, receive some income like rent, or take out a new bank loan. It's a really simple, elegant split.
Let's actually walk through a real-world illustration from our source material to see how clever this system is in practice. Take a look at this. On September 21, 2014, a company called Mohit Chemicals needs to pay HT Chemicals a pretty hefty sum, 200,000 rupees. But they split the payment. They pay 40,000 in cash and the remaining 160,000 via a banker's check. See how this split payment is organized so effortlessly onto a single debit voucher? The total debit to HT Chemicals is the full 200,000, and that is perfectly balanced by crediting cash for 40,000 and crediting the bank for 160,000. It's clean, it's clear, and it handles a complex payment without breaking a sweat.
Next up is Section 5, the transfer voucher.
But wait, what happens when we do business on credit and no actual cash is immediately changing hands? For these super common non-cash events, we use what's called a transfer voucher. Think buying or selling on credit, returning items, logging the depreciation of your equipment over time, or writing off bad debts. Since there's no cash moving to trigger one of those cash vouchers we just talked about, a transfer voucher is created, where both the debit and the credit forms are filled out simultaneously on the exact same piece of paper.
I love this next example. Just look at how this stationary mart illustration captures this wildly complex mix of balances on April 1, 2014. This single transfer voucher is basically acting as a universal translator for the entire state of the business at that moment. Over on the debit side, we've got all the assets: cash, bank, furniture, land and building, and debtors, and they all total up perfectly. Then, on the credit side, it maxes out the secured bank loan, the creditors, and the remaining capital acts as the balancing figure. It takes the sprawling, messy reality of everything a business is worth and condenses it into one elegant, balanced snapshot.
And finally, we arrive at Section 6, the accounting equation.
All this meticulous tracking, all the paperwork, the vouchers, the receipts, it all builds up to one universal truth, a very simple equation. Basically, whatever a business possesses in the form of assets is entirely financed by somebody, either the owner themselves or by outside parties. Therefore, your total assets must always exactly equal your total equity, no exceptions. When we expand that out, we get our golden accounting equation: assets equal liabilities plus capital. To put that into perspective, imagine an owner, let's call him Sunil, starts a brand new business by injecting $300,000 in cash. Boom, a new asset is created. But that asset didn't just magically appear out of thin air, right? It is perfectly balanced on the other side of the equation by $300,000 in capital. Every single time a voucher is filed, it shifts these numbers around, but the equation itself must forever remain in perfect harmony.
Which leads us to a really fascinating thought. If every single voucher and receipt exists just to keep this grand golden equation in perfect balance, what happens to a business's entire foundation when just one single source document goes missing? It's a wild reminder of the sheer scale of accounting. The massive, towering architecture of the entire global economy literally rests on the humble, perfectly filed receipt and the accurately written voucher. If just one transaction slips through the cracks, the golden equation breaks. It definitely leaves you wondering, just how fragile is that paper trail in the chaos of the real world, and how much trust are we placing in the accountants keeping our scales balanced? Thanks so much for joining me on this explainer. I hope it brought a whole new level of clarity to the incredibly structured world of accounting.